Yes, welcome to this webinar with SKAGEN Focus. It's myself, Jonas Edholm, and presented together with David Harris as per usual. And indeed, it's been a couple of turbulent months, really, or maybe the entire 26 so far has been pretty turbulent in terms of market action. Of course, we've seen the initiation of a war in Iran, which has affected energy prices global and also other commodities, which has induced inflation worries in global financial markets. The market has been surprisingly resilient regarding these events, and we'll see how the fund has fared in terms of performance and so on in this environment. And we will also look at new positions and the portfolio construction of SKAGEN Focus as we stand right now. So as a reminder, SKAGEN Focus, what makes this fund different from other global funds, where there's a few things. And we have a focus on small and mid-cap companies, and we're thinking mid-cap companies up to maybe, I think our largest position is about $30 billion US dollars in the fund. We have an average market cap of $5.5 billion US dollars. That's pretty much in line with a small mid-cap index global. We look for these deep discounts in global equity markets, which you would expect from a value investor like ourselves. We're also contrarian investors, so we look for stocks where perhaps few others are looking at any given moment. We demand a 50% upside in equity price on an horizon, investment horizon of 2 to 3 years time, at least, to be interested to invest. And that is on a steady state normalized earnings power basis. We also like to combine this with strong balance sheets with potentially hidden assets like net cash balances, like cross holdings, properties, and so on that might be sort of come to shareholders' pockets as well. So we look for these capital allocation triggers widely across global equity markets and in our holdings. We also have that green transition investing angle, which we believe is very exciting and provide us with an interesting equity trigger actually in many of our current investment cases.
Yeah, so just a brief recap on the investment process and the team. This is a price-driven investment philosophy. It's all about value. We're guided by value and cheapness. Nothing comes into the fund if we can't find it at a substantial discount. At least an upside of 50% has to be identified for anything to qualify into the fund. But cheapness is not enough. As Jonas said, we need to see tangible potential for re-rating. So we look for catalyst change that can drive the investment thesis and support the re-rating. And then, of course, the third building block is common sense. There's a high degree of common sense in our conservative valuation approach. We focus on normalized earnings potential. We focus on risk diversification among fundamental risk factors, on companies that have solid ability to generate free cash flow here and now with strong balance sheets. And of course, it's me and Jonas. We have been working together now for more than 15 years, I believe, with this type of value investment approach. And we're well rooted in SKAGEN, which, as most of you know, have been doing value investing for over 30 years now. We call ourselves contrarians. And what do we actually mean by that? So for us, being contrarian is all about trying to identify different phenomena in the market that are contrarian and where the likelihood for market inefficiency is much higher. So just to give you a couple of examples, what we look for, it can be as simple as that some companies tend to be misunderstood. It can be the case that they have their operating assets in one part of the world, but is listed in another part of the world. And just that can create some misunderstanding in the investment community. We look for unwarranted market perceptions. We look among companies which have a lower market cap and lower free float, where there are less eyes looking and doing due diligence, and we have an advantage going into those situations. We look for areas that tend to be forgotten or ignored over time, and here we benefit from our broad and global mandate. And then, of course, below the radar situations, such as what we like to call the mother of all market inefficiencies, spin-off. So when a new company comes to the market, coming from another company, it's not so known. It starts trading. Most people get it in their laps because they own the mother company. It might be part of an index, and that's why they own it. So there's a technical pressure when people sell by default. And here we tend to do the work before. And if the price is right, very interesting opportunity can arise in these situations. But in essence, we're looking for value. So we try to spot these market inefficiencies.
So the reason we call this presentation Winds of Change is that we think there's a few winds blowing that is sort of changing the investment landscape. And there's maybe an emerging normalization underway in several different areas. For instance, we've seen small and mid caps performing much better relative to large mid caps over the last 6 months or so, despite the war outbreak, which has sort of delayed that normalization a little bit maybe. We're also seeing emerging markets trading much better than developed markets, and in particular, the US market. And there's a few reasons why this is happening right now. And one reason is we think there's a growing scrutiny of AI-related investments in global equity markets. Investors are no longer just taking these investments for granted. They wonder, what are the actual returns of these massive capex that the hyperscalers in the US, mainly US, are spending on these data centers? It's an unknown. And you see, when these companies now come with higher capex numbers, the stocks are actually falling for the first time. And that's a pretty interesting signal. We also seen the AI rally sort of broaden out into these commoditized or more or less commoditized products like memory and hardware and so on. So this is where we stand right now. But the main thing that's been affecting the US are the slower performance of the hyperscalers, to be frank. And you also have the disruption risk from AI. These investments will eventually disrupt several areas, several companies, several layers of companies and value chains. And that is something also that is highly represented. These quality companies, these moats, are also highly represented in the US with trading at high multiples. And are now seeing potential disruption in 3 to 5 years' time. And that is setting down these multiples. So these forces have sort of propelled, we think, these rotational trends in global equity markets. So we have a few more slides that I think is interesting from that point of view. Just to highlight the concentration in global equity markets, you're seeing to the left here that the top 10 positions in the MSCI All Country World, if you buy an index, is still in the 23% range of the total market cap. The high point here was 25%. So that means there's been some normalization here. The small cap and mid caps are of course not as concentrated as the large cap areas. And you'll also see that, which is the bar to the right, you also see that the valuation of these top 10 companies in the MSCI All Country World, when you buy an index, have a very high valuation at the P ratio about 47, price book 20 times, EV sales 13 times. So this is still not a cheap area of the equity markets, and this is mainly the hyperscalers, the big tech companies, and a few more stocks. And then you see the area we're sort of looking at. That's the small cap area of the small and mid cap, the value area of the small and mid cap area, basically to the far right, which is trading at multiples which we think are still very attractive. So you're seeing these shifts, which we think is interesting. And this is just to highlight how the markets still are very concentrated if you buy an index fund in large caps. So moving on, you also see that the fundamental headwinds for these tech giants, which we alluded to in these key forces, it's also showing up in earnings growth. It's showing up in the free cash flow dynamics of these companies. There's still earnings growth, but it's slower. And it's the law of the large numbers basically kicking in. They're so big, they're hard to grow their earnings at that very high pace from now on. And you see the free cash flow almost moving into negative territory just because of these AI investments. So no more buybacks in these share buybacks in these big tech companies in the US. And this has sort of affected the performance versus the rest of the world. So that is what we're seeing, and potentially a trend developing here. And also that's visible if you look at the next slide. you'll see that the small and mid caps, which we plotted here, versus mega large cap stocks since 98 have been, you'll see there's been a few periods where small mid caps have been really poor versus the large caps. That was in the global financial crisis. There's also been now an 8-year sort of desert walk for small mid caps, which is also somewhat an anomaly in global equity markets. But we're now seeing the first sign of this. This is maybe sort of normalizing, or there's a rotation going on between these two segments, which is kind of interesting. And you also see that the discount which the small and mid-cap stocks have traded on, the low point was 18% in terms of PE ratios and 45% in terms of price book. They have now started to reverse for the first time. This is a movement that's been going on maybe over the last 6 months or so. And normally the small and mid-cap space globally is more expensive than the large mega caps area. This is the relative valuation number you're looking at here in these charts. So again, it's a trend worth highlighting and monitoring going forward. And indeed, if this were to be the case, I think SKAGEN Focus is a pretty interesting investment opportunity versus the index basket, the big large cap basket. And also just showing you, this is not entirely updated with the last few days, but up until May 15, we've seen that slower US, this is the US versus the rest of the world we have plotted here in terms of performance. And that has indeed been a much slower development in terms of ups and performance than the rest of the world. So this is showing you the dynamics. We also forget we had that period from 2001 to 2007 where the US was a very poor place to be in terms of capital allocation versus the rest of the world. So you really had this very extreme period between 2009 up to 2000, maybe then end of 25 basically. So this is also just the result of all these arguments we're now presenting.
Right, and then moving now over to the fund and our exposure and some interesting themes we think are worth highlighting, starting with, of course, South Korea. For those of you who have followed the fund for a couple of years know that this is a very, very big theme and has been one for the last couple of years. Of course, guided by value in our investment process, we saw a lot of opportunities in South Korea. I think 2 years ago, we increased our exposure to over 20% of the fund was exposed to South Korea due to this very exceptional combination of discounted opportunities, strong, well-positioned companies, and of course, the entire value-up reform that we saw coming, supported by the government in South Korea. And we saw a lot of similarities to what we have experienced reshape Japan over the last 10 years, which was a big theme for the fund as well. South Korea has been, of course, an exceptional story over the last 2 years, which has been a solid contributor to the fund. The value-up reform has certainly been a driver, but of course also the companies that are very much in South Korea exposed to the AI semiconductor increased capex demand, especially the larger names such as Samsung and Hynix has been driving the Kospi index, and we have been exposed to several companies and had a strong re-rating, actually closed a couple of positions at price target, which we'll get back to. But it's worth noticing that this discount, the Korean discount has been challenged, and that rally is broadening, especially among financial holding companies and asset-rich businesses. And we see several catalysts playing out there. We have trimmed our exposure. We have currently around 17% in South Korea still, and are trimming into strength and being much more selective, but still see some opportunities among especially the smaller names. So just worth highlighting that. Another region which we want to bring to your attention is the ASEAN region, which we have been spending quite some time on over the last couple of months. We have been meeting companies. We actually traveled to the region and been doing some research and see a lot of interesting things going on. Of course, this is not a single market. There are many different countries with very much different dynamics and ownership structures and reform drivers going on. I want to highlight especially two parts of this region we think is interesting, Indonesia and Thailand. We'll get back to Indonesia in later updates, but we want to bring Thailand to your attention. We think Thailand has many similarities to what we've seen in South Korea and especially Japan. You have an under-owned market with very low valuations and cash-rich companies, and we've seen pressure for reform starting to grow. There's a jump program driven by the stock exchange to push companies to publish value creation agendas, improve disclosure, which we think all is very encouraging, and we are expecting to follow this and see how this will play out over the coming years. We have initiated a new position in the fund in Bangkok Bank, which fits this theme quite well, as we saw in Japan and South Korea. This is usually where these type of reforms tend to first bear fruit. Bangkok Bank is a very conservatively managed bank. It's overcapitalized, trading at very attractive valuations, and has a strong potential to improve its capital return profile. So excited to follow that name going forward.
Yes, so we often show you this picture with our different value spectrums, and we have many different types of value in the fund. Mean reversion being one, economic return value being another, and the stock that David mentioned, just Bangkok Bank, would probably be positioned in an economic return value basis. It's not on this box, but it's an extremely cheap stocks with a current earnings power that we think is justifying a price target which is way over 50% higher than we invest into. Mean reversion value is more of stocks where you have this potential for things to normalize. A good example would be Wienerberger, which have this pipe business in Europe and brick business as well on top of that, and even present in the US, where the end markets are down by 20-30% since 2021. And you have also normalization potential on the cost side, huge optionality in Ukraine-Russian peace environment and so on, be that being trading very cheaply on normalized earnings power, we believe. And these Korean stocks, David mentioned Korea, that we're still invested in. We have a few names still in Korea. It's less than we had before, but we have a few names that we will mention. Hyundai Mobis, for instance, and KCC. Those are more or less investment conglomerates, but within the industrial business as a base, trading at very cheap multiples. And we're also very interested in discount and discount value stories where you have layers of discount. And that's very common in Korea as well, with the ordinary share and the pref share structures. And our fair share of restructuring and breakup value cases, where it's more sum of the parts related stories. So this is just to show you how we diversify on these different value buckets, if you will, in the fund.
Yes, and this chart shows you it's actually a comparison done by a third party that compares our fund versus other global equity managers. And what really stands out here is, of course, our focus on cheapness. We are the cheapest fund out there when it comes to price to earnings and price to book. So if you want to have something in your overall global portfolio that really has this value angle, this fund definitely fits that purpose. But it's also interesting to note that we're in the higher percentile when it comes to dividend yield distribution, and this also reflects our focus on near-term cash flow generation ability within the fund. So that's a good complement. If you look at our geographical exposure, it's quite interesting to note that we're quite differently exposed if you would compare us to an index, either the big ACWI or the small mid-cap ACWI, which is very much exposed to the US, as you can see on the chart here, while SKAGEN Focus has a much lower exposure to US. And that, of course, reflects that we struggle to find good investment opportunities over there due to the quite high valuation, and find more attractive opportunities elsewhere, especially in Europe. There's a lot of discounted opportunities for us, and in the rest of the world. We mentioned South Korea, for instance. So also here you see that the fund complements your overall global portfolio quite well.
And looking at, we are very disciplined when it comes to price. You know, we have one target price in mind, which is at least 50% upside from where we enter the stock, and when the stock hits its price target, we exit that position and invest into a new discounted holding. And here we have a few examples of these stocks that has been going into price target lately. Aperam, our stainless steel company, we invested sometime in 23, I think maybe early 24 in Aperam. It has been rallying since that point. It's the steel shield coming in Europe, which has been sort of the market is front running that event this summer. We still hold Acerinox, which is a familiar name, but also they have a large US business on top of a European stainless steel business. So Aperam has been driving performance. Doosan Bobcat, that's the machinery maker in Korea, has been re-rating towards our price target. As well as Siltronic, which has been sort of a frustrating position for us. We've probably been holding it for almost 3 years. Finally, the markets discovered the potential shortage of wafers coming in maybe 27, early 28, but the market is now sort of front running that type of events, propelling the stock to our price target as well. So all of these names have exited the fund, and also DLENC, a South Korean construction company, also active in producing smaller nuclear reactors and so on, has been exiting the fund at price target. And the drivers, apart from those names I just mentioned, we can mention Hyundai Mobis, which has been holding for, I would say, at least a couple of years. And it's only now the market is starting to appreciate what this really is. They're a big holder of Hyundai Motors. They're a big holder of Hyundai AutoEver as well. So I guess the market cap of those two names, those two holdings in Hyundai Mobis is now about half the market cap or something like that in this particular name. It's an auto parts producer, but Hyundai Mobis is also being recognized now increasingly as a parts producer to robotics. And that is mainly the actuators, you know, on these robotics. They own stakes in Boston Dynamics together with Hyundai Motors. And the stock has now re-rated sharply from the very discounted levels. It's still quite cheap. But the market is now really finding that name, which is have been rallying hard, and we have some distance to our price target still. DLENC, I mentioned, have exited the fund. Siltronic, we mentioned. And on the losing end, we don't have much this year to speak of, really, which has been one of the strengths so far this year. We have managed to cap the losing side pretty efficiently. So the return in euros about 10%. This was a while ago, but somewhere along those lines. So that's where we stand currently. And the return picture, if you look then to the far right in the picture of year-to-date 26, the fund has performed basically in line with the MSCI SMID index, somewhat better than the ACWI. So in the beginning of the year, we had a much higher distance to the ACWI index. So we lost some ground since then. The market has been coming back broadly. Looking back, we have 25 being a very solid year for the fund. 24 was a very poor year for the fund, and that is sort of affecting these longer-term numbers, where you had the AI rally, you had the dollar rally, the big tech companies doing really well, which sort of we did not represent in that, we did not perform in that environment, basically. 23, 22, 21 being much better. So that has been the picture if we look backward for the fund. And these new positions that we mentioned a few positions for you, and we can also mention a couple other positions. Amovio being a top 10 position, that is a spin-off, like David mentioned. We look for these spin-off situations where something completely new drops down in the market. And Amovio is a leader in radar, for instance, sensors and so on, and software as well into cars, work with all the big OEMs, basically, as an auto parts producer. And this is trading at an insanely cheap valuation, we believe, at about 1.5 times EBITDA. So the core earnings it takes them 1.5 years to earn their market cap, which is amazing, really. Nothing can stay that cheap for long, but the market hasn't really discovered that name yet. It's trading around those levels that we entered into maybe 6 months ago or so. Taihei Cement being a new company in the fund. They have a very interesting Japanese steady state earning Japanese cement operation, but they also hold a US operation, which we think is completely ignored in Taihei Cement. Now there's an activist coming in pushing for them to monetize the US part of Taihei Cement, maybe listing a carve of the US business, which we think would crystallize a lot of value for shareholders. If we value the US business as we think it should be valued, we think this is trading at around 3.5 times EV/EBITDA. It's very cheap for a cement producer. And Everest Re, we find some stocks in the US, not much because it's a very expensive equity market. Everest Re being an exception, or the Everest Group. It's being a very diversified leader in reinsurance, and it's doing a restructuring of the business, exiting non-profiting lines and focusing more on the profitable side of their business, trading at 6 times earnings, below book value for being a US company, which is extremely unusual. So we think this is a very interesting restructuring story going forward in Everest Group. It's about 2.5% of the fund. And then also we have Samsung Fire Marine. We want to dive into a few other names these are not new names, these are existing names that our conviction has been growing. And in Samsung Fire Marine, now we're back into Korea. That's one of those cases where you have an interesting asset backing, to say the least. They hold a stake in Samsung Electronics. This is a property casualty company in Korea. Their property casualty business is definitely okay, generating about $3 billion US of operating income, operating earnings each year. On top of that, they have the Samsung Electronics stakes, 1.5% to be exact, and that's about $16 billion US worth. That market cap. That's what the whole market cap is of this company. And there's another, so this is a sort of a backdoor coming into a Samsung Electronics exposure, basically, if you're willing to look at that way. Also, it's a huge discount on the pref shares that we hold to the ordinary shares they're trading, about 30% discount. So you have a discount on discount value, you have the asset-backed value, and you have a very stable earning and potentially improving insurance business in this company. So we've been increasing our position in Samsung Fire Marine. I think it could be worth at least 70% higher than current stock price. They could come with a special dividend from Samsung Electronics, for instance. It could be propelling capital allocation events in Samsung Fire Marine on these extremely cheap valuation levels that they're trading at. So and they also hold treasury shares, about 17% treasury shares as well. So this is really a case with very high optionality in terms of winning or moving towards our price target.
Yes, and lastly, we just want to highlight Hitachi Construction Machinery, which is a company we have followed for many years, and it now replaces Doosan Bobcat, which Jonas mentioned, exited the fund at price target, the Korean construction machinery company. There are essentially two things going on within Hitachi Construction Machinery that we want to highlight and which we think is very interesting. First of all, shares have now sold off in this geopolitical tension. We think that this company is uniquely positioned to benefit from structural tailwinds, especially its growing exposure towards the mining industry. Now, the mining industry has been underinvesting for many years. And of course, these companies within that industry are now benefiting from much higher commodity prices, generating very healthy cash flow levels, which are now adding to their firepower to spend on capex, which would benefit companies like Hitachi Construction Machinery over the years to come. And we think that is not fully understood by the market. Second, which is very interesting, is that the mother company Hitachi has been selling down their stake and continue to do so, deeming this business not non-core. which is essentially creating this standalone new entity, which has a much higher degree to be able to pursue its own strategy and to really emphasize on some of the opportunity that are present for this company. Also, the exit from the JV they had with Deere in Americas opens up a lot of interesting opportunities that we think can enhance the margin profile for a company that is now trading not only at a discount to peers globally for being such a global leader, but also on an absolute basis. So we see a very strong opportunity here for re-rating over the years to come, with an upside in excess of 60%.
Yes, and taking a look at our top 10 position, we mentioned many of these names in this presentation. We mentioned Mobis, Amovio earlier here, and Samsung Fire and Marine, of course. Methanex, being a very large position in the fund, is worth highlighting. The methanol price has been skyrocketing in terms of the US-Iran crisis. 10% of the global methanol supply is coming from Iran, that area of the world. So Methanex is now finally should be seeing its fair share of higher prices and steady state volumes. There's the biggest methanol producer globally. So we think it's trading at way too low multiples, and we think earnings are highly underestimated in Methanex going forward here. So that's a big conviction name for us as well, high conviction name. On top of that, we have a solid upside to our price target weighted with the fund, about 70%. 34% is initiated less than a year ago, which is a number we like to have pretty high, because that means you have a very fresh exposure as a unit holder. And of course, trading at very cheap multiples to an index at 70% of book value versus an index which is way higher, and about 10 times price earnings across the fund, compared to an ACFI about 18, 19 times as it stands. So that is the top 10 basically. And just to sum up what SKAGEN Focus is different, it's based on cheapness, change, and common sense in the global small mid-cap area. It's very difficult to find, value investors with a contrarian angle in this area of the global equity market, which is an opportunity for us, of course. We're seeing those winds of change in terms of small mid-caps versus mega large caps, and emerging markets versus developed markets, and in particular the US. The winds may be changing here. And David described we have seen new opportunities in ASEAN, for instance, following Japan and South Korean value up dynamics. So we're active there, and our potential is we're going to be even more active there as time moves on, and we find new investment cases. And we still have a substantial upside exposure to Europe, less than before. We've sold off a few names like Aperam and Siltronic, but still a pretty substantial exposure to European discounted, more cyclical type of names, and a substantial upside to our price targets across the fund, 70%. So I think that was what we had today.